Imagine waking up tomorrow and hearing that tensions between the United States and Iran have suddenly escalated. Oil prices spike, overnight markets become nervous, and investors across the world start asking the same question: what happens to real estate now? It might sound surprising, but global conflicts like this can quietly influence the property market in ways most people don't realize. When geopolitical tensions rise, the first market that reacts is usually oil. The Middle East is one of the most critical energy regions in the world. If there's even a small risk of supply disruption, oil prices can jump very quickly. And when oil prices rise, the impact spreads across the entire economy. Transportation becomes more expensive, manufacturing costs increase, even basic materials used in construction start to cost more. All of this pushes inflation higher. Now, here's where the real estate market begins to feel the pressure. When inflation rises, central banks often raise interest rates to slow the economy down. And higher interest rates mean one important thing for anyone thinking about buying a home: mortgages become more expensive. For many families, that suddenly makes buying a house much harder. Monthly payments increase, borrowing becomes more difficult, and many potential buyers decide to wait. As a result, housing demand in some markets can slow down during periods of geopolitical uncertainty. But the story doesn't end there. Real estate is not just about people buying homes to live in, it's also a major investment asset. And during times of global uncertainty, investors often start looking for places where their money feels safe. History has shown this pattern many times. When the world feels unstable, investors often move their capital into property markets in politically stable countries. Cities like New York, London, Toronto, and Sydney suddenly become very attractive. Why? Because real estate in these locations is often seen as a long term store of wealth. Even if markets fluctuate in the short term, investors believe these cities will remain economically strong over time. So, while geopolitical conflict can create fear and uncertainty, it can also redirect global investment. Money that might have gone into risky markets sometimes flows towards safer property markets instead. At the same time, construction companies face their own challenges. Rising oil prices increase the cost of transporting building materials. Steel, cement, and labor can become more expensive. For developers, that means building new homes becomes more costly. Some projects get delayed, and fewer new developments may start. Over time, this can even reduce housing supply in certain markets. So, when you really look at the bigger picture, conflicts like rising tensions between the United States and Iran don't just affect politics or military strategy. They can influence oil prices, inflation, interest rates, investor behavior, and even the future supply of housing. And all of those forces eventually shape the global real estate market. In the end, the real question isn't just whether conflict creates risk. The real question is how global money moves when uncertainty rises, because that movement of capital often tells the real story behind the world's property markets.